Australia just detonated a financial earthquake, not a tremor you'd feel beneath your feet, but one rippling through the global monetary system. And it didn't come from Wall Street or the Federal Reserve. It came from a quiet deal in Beijing that now threatens to redraw the financial map of the 21st century. The moment arrived in early August 2025, when Fortescue, one of the world's iron ore giants, made a move no Australian corporation had ever dared before. Instead of heading to Wall Street or the City of London for financing, it turned to China. Fortescue walked away from the dollar, walked away from U.S. lenders, and signed a loan worth 14.2 billion yuan, nearly $2 billion US, with the Bank of China and the Industrial and Commercial Bank of China. The terms stunned analysts everywhere. A fixed interest rate of 3.8%, almost identical to what the Australian government itself pays when it borrows. Stop and think about that. A sovereign state can always tax its citizens or print more money. A private mining company cannot. Yet Beijing's banks offered Fortescue nearly sovereign-level credit. For Fortescue, this was the lowest cost of debt it had ever secured in its history. And for the financial world, it was the sound of a fault line splitting open. But this was only the opening shock. Just weeks later, Australia's Treasury followed suit and issued its first yuan-denominated government bond. Days after that, the Reserve Bank of Australia quietly announced it had shifted a quarter of its reserves into Chinese currency, a jump from just 5% the year before. Central banks do not usually pivot this quickly. The IMF, in its September 2025 consultation report, said no advanced economy had ever moved so aggressively into Beijing's orbit. For Australia, this wasn't diversification at the margins. It was a structural break with decades of financial alignment to the U.S. Why would Canberra take such a step? The answer lies in Fortescue's pivot away from America. Earlier that year, in February, the company had admitted that its $550 million hydrogen project in Arizona was wobbling under changing U.S. regulations. By July, the project was dead, and Fortescue booked a $150 million impairment charge. The Wall Street Journal described it as a symbol of investor uncertainty in U.S. clean energy policy. Fortescue cut its losses and walked away from its American experiment. And almost immediately, it turned toward China, not only as its primary buyer of iron ore, but now as its financier, its supplier, and increasingly, its strategic partner. The company's decision wasn't just about cheap credit, it was about alignment. China already purchases more than 80% of Fortescue's iron ore. By borrowing in yuan, Fortescue matched its debts to its revenues, reducing foreign exchange risk almost to zero. The Financial Times later revealed that the loan was tied to Fortescue's push into green steel, with $400 million worth of equipment sourced directly from Chinese firm XCMG. Beijing wasn't only buying Australia's commodities, it was selling the tools to reshape its industry. And the trend didn't stop with one mining giant. In August, Reuters reported that Australian law had quietly been amended to permit syndicated yuan lending inside Sydney, with both Chinese and Australian banks participating. That small regulatory shift made Fortescue's deal possible. If other companies followed, the impact could be seismic, threatening the dominance of U.S. dollar clearing in Australia's corporate debt markets. Already, the numbers are moving fast. On September 1st, the Australian Bureau of Statistics revealed that 14% of Australia's exports to China were now invoiced directly in yuan, up from just 3% the year before. The IMF calculated that if the trend continues, Australia could cut its annual dollar reserve requirements by the equivalent of $20 billion. That's not theory, that's cash the Reserve Bank no longer needs to hold in dollars, cash it can reallocate elsewhere. Banks, too, are adapting. ANZ announced in June it had launched yuan clearing services for corporate clients. Days later, the People's Bank of China unveiled preferential cross-border clearing fees, just 0.05% for yuan transactions, compared with 0.25% for dollars, a 3-year subsidy designed to accelerate adoption. Companies are responding to the incentives. A senior mining executive told the Financial Times that shifting procurement into yuan was not only cheaper, but reduced reliance on U.S. lenders. Meanwhile, Australia's central bank confirmed what observers had already begun to suspect. Yuan now accounted for 25% of its reserves, up fivefold in just over a year. The IMF reported that across the Asia-Pacific region, the average increase in yuan holdings was 40% year-on-year, but Australia's pace left even its neighbors behind. This wasn't cautious diversification, it was acceleration, and Washington noticed. A leaked cable, reported by the Financial Times on September 3rd, revealed that U.S. officials were monitoring yuan bond activity in Sydney with what the cable described as growing concern. To America's financial establishment, Australia's move was not a benign hedge, it was a strategic signal. Inside Australia, institutions are embedding yuan more deeply. The Future Fund, the nation's sovereign wealth pool, announced it would permit up to 10% of its assets in yuan starting next fiscal year. Superannuation funds launched yuan-denominated infrastructure vehicles, targeting everything from green hydrogen projects to logistics hubs. Even the Port of Newcastle, Australia's largest coal terminal, processed its first yuan-settled shipment to Guangdong. Port officials described it as administratively smoother than dollar invoicing. The financial infrastructure is shifting in parallel. The Australian Stock Exchange confirmed it will list yuan bonds beginning in October 2025, allowing companies to tap Chinese investors directly from Sydney. Bloomberg data showed daily turnover in the Australian dollar-Chinese yuan pair doubling in just 3 months, hitting $2 billion by late August. Meanwhile, trading volatility in the Australian dollar-US dollar pair dropped 15% in the same quarter, as more trade migrated into yuan. The fiscal implications are tangible. Canberra's budget papers estimated that yuan-based borrowing saved the federal government nearly 200 million Australian dollars in interest payments during 2025 alone. That's not a projection, it's money already banked, reducing the strain on taxpayers. Momentum is spreading into private capital markets. A major Australian investment firm disclosed plans to issue its first yuan-denominated green bond in early 2026, marketing it to investors in both Sydney and Hong Kong. If successful, it would extend de-dollarization beyond sovereign and trade finance into private debt. The scale is staggering. The People's Bank of China reported that cross-border yuan trade with Australia had already surpassed $50 billion in the first 7 months of 2025, eclipsing the totals of the previous 2 years combined. That pace, if maintained, will leave the US dollar sidelined in Australia-China commerce. So what does this all mean? On one level, it's pragmatic. A nation whose largest trading partner is China is simply aligning its financial architecture with its economic reality. But on another level, it represents a tectonic shift. The dollar's dominance rests not only on America's economy, but on its role as the default currency for trade, reserves, and debt worldwide. If Washington's closest allies begin conducting business in yuan, the foundations of that dominance weaken. There are risks. The Lowy Institute warned that Australia's rapid diversification could complicate access to Federal Reserve swap lines during crises, reducing its connection to US-backed liquidity networks. Treasury officials counter that diversification is a form of insurance, not betrayal. Yet the balance is delicate. With every bond issued in yuan, every port shipment settled outside the dollar, Australia edges closer to a financial ecosystem in which Beijing's influence is unavoidable. The unanswered question is whether this represents diversification or dependency. By embedding yuan so deeply, Australia reduces costs and hedges risk, but it also exposes itself to Beijing's financial leverage. What happens if political relations sour? What happens if the People's Bank of China tightens rules on clearing or lending? For now, the benefits are clear, but the long-term price remains uncertain. Still, the momentum is undeniable. Fortescue's loan wasn't just a corporate financing choice, it was a symbol of a larger rebalancing. Australia is no longer just selling to China, it is borrowing from China, buying from China, clearing through China, and increasingly storing its national wealth in China's currency. Each step is small enough to be justified, but together they form a pattern that the IMF, the US Treasury, and global markets cannot ignore. And that brings us back to the opening question. If Australia, a Five Eyes ally, a Pacific democracy, a partner bound to Washington by decades of military and intelligence ties, if Australia can pivot this quickly toward the yuan, then what does that say about the future of the dollar? The story doesn't end with an answer. It ends with a number. More than $50 billion worth of Australian trade settled in yuan in just 7 months. That's not an experiment. That's a trend. And if that pace continues, the US dollar may not just lose ground in Australia, it may lose the status it has held unchallenged for nearly a century. Australia's financial earthquake has already begun. The aftershocks? They may reverberate across the entire world economy. So buckle up, the dollar's grip is slipping, and the question that hangs over all of this is simple. If America's closest allies are already bankrolling their future through China, how long before the rest of the world follows?